Varun Goel, head of PMS with Karvy Stockbroking, joins us live from Mumbai. Varun, good morning to you. Thank you for joining us. Varun, at a time when global fear has taken center stage, what are you telling your clients and how are you allocating money?
Yeah, hi, good morning. I think next 2-3 weeks are going to be extremely volatile and turbulent. I think markets are going to discount the event, pretty much before 16th and 17th of June. So, and of course, there's a big scare building up in terms of what's going to happen to Greece, what's going to happen to Euro area as a whole. And we've already seen all asset classes reacting to it, be it commodities, be it equities. And we're already seeing some kind of pressure on the real estate in the short to medium term. So definitely it's going to be very tricky. Our own sense is that it is very difficult to time the equity markets in the short to medium term. And the current valuations definitely remain supportive as far as Indian equity markets are concerned. So our advice to clients is to stay invested, but prefer defensive spaces. Don't venture into risky territory. But I guess the storm will pass away. It's another 2 to 3 weeks away. We will, I think, very soon see a very definitive action by US Fed. I think third week of June should see a QE3, which almost looks inevitable now, which should lead to some kind of a relief across asset classes in the world. But I think next 2 or 3 weeks are going to be extremely volatile and turbulent.
So Varun, besides QE3, for India in particular, domestically, what could it provide that kicker in terms of a fundamental trigger amidst all the gloom and doom?
I think in India things happen on their own. No one really does anything. So what we are seeing as far as the crude oil prices are concerned, Brent crude price have fallen almost $30 from the peak in March. And I think sooner or later, markets are going to start reacting to that. So what we have seen, both in terms of risk on and risk off, there is a very strong positive correlation between Indian equity and crude oil prices till a certain level. So till the time Brent crude reached $120 a barrel, Nifty was moving almost parallel to that, and then that correlation broke down. And I think on the lower side also, Nifty and crude oil are continuing to fall together. But somewhere down the line, maybe around $85, $90 a barrel on Brent, that correlation is going to break down. And then Nifty is going to start moving in the positive direction for any further fall in crude oil prices. Let's not forget that most of the concerns about India, be it fiscal deficit, be it current account deficit, emanate largely from very high crude oil prices. And a significant correction in crude oil, of course, provided rupee stays put and it doesn't weaken any further, is going to be a definite positive as far as Indian equity is concerned.
What is your sense of how the OMC basket is likely to react on account of the marginal petrol price rollback? Or do you think materially we could see a move only once diesel and other petroleum products or rather other fuel product prices are increased?
I think considering the way the whole petrol price thing was carried out, we have very little confidence that something concrete will happen either on diesel or kerosene or LPG subsidies. In fact, if you look at last 2 years, every year during the month of June is when diesel and LPG prices are hiked, and this time we don't really see that possibility. So our own sense is that we would want to stay away from anything which has very high government interference.
What should be the right investor approach right now? Are you asking your clients to start nibbling in and bottom fishing into individual stocks?
Well, I think definitely you can't really time the markets. As we saw even in 2008, the markets did bottom around 8-10 times 1 year forward earnings. And if we look at the market's valuation today, we are trading almost 11.5 times FY14 earnings. And I don't think we are very far away from the bottom. Of course, it's very difficult to say whether it's going to be 5% more from these levels, but we are somewhere very close. And therefore, it's a very good time to start picking equity. Of course, one has to look at the time horizon for the investors. I think if anybody who has a time horizon of more than 1 year, now is the time to start building a portfolio. As far as sectors are concerned, we definitely believe that banking and automobiles are definitely getting cheaper. We are going to see some monetary policy action by RBI very soon. If not in the month of June, then definitely in the month of July. So we believe that more than 100 basis points cut of repo rate will happen during the course of the year. And therefore, any sector which plays the monetary easing cycle looks extremely attractive at the current valuations.
What do you think will change in next 1 year? Why do you think investors, they should buy equities?
So what we have seen is that every time, we have seen these periods of extreme optimism and extreme pessimism. Now, even in 2008, when the market came down to 8,000, even that valuation was not justified. So was the sense that, when the market touched 21,500 in 2008. So I think markets do, react to human emotions. There are wild swings. which are very different from the equilibrium valuation. We don't believe the equilibrium valuation of the market 1 year down the line would be closer to these levels. We believe that the equilibrium valuation definitely will be closer to 19,000 or so on Sensex. So definitely someone who's looking for a medium-term kind of approach, this investment in equity at this point of time definitely makes a lot of sense. Of course, we are not saying this is the worst that it can get. It could get a little more volatile and turbulent, as I mentioned in the early part of the interview. But one needs to have that patience. One needs to get into the market, assuming that a 10 to 15% kind of crack in stocks is definitely possible. But if you take a 1 year plus kind of a view, there is definitely upside, which is waiting out there.
What is your sense in terms of what the RBI action is going to be in the June review? And do you think the Reserve Bank of India would cut rates because inflation hasn't peaked out, but growth definitely is slowing down?
I think what we saw with the last 50 basis cut was that RBI was not fully able to pass that on in terms of actual transmission in the monetary system. I think it will be a better a way of cutting rates would be through a CRR cut, because we continue to see a liquidity situation remain extremely tight. The kind of open market operations that RBI has to do to absorb the liquidity, to provide the liquidity which gets absorbed because of the dollar-rupee trade balance that the RBI tries to do, has made the things extremely difficult. So I think CRR cut definitely looks a better option at this point of time. I think overall, if you look at, if you would take a 12-month kind of a view, it is very, very clear that unless the RBI does something, the growth is not going to revive. So I think, considering the fact that we don't really have a very functional fiscal policy, the burden of reviving the growth lies completely with the RBI, and I think RBI would be very cognizant of that fact. And hence, we believe that despite the fact that inflation remains stubborn at around 7.5–8%, as far as the WPI is concerned, we are going to see aggressive monetary policy actions by RBI in the months to come.
So Varun, the script of how Indian markets moved in the month of May was largely influenced by two factors, Europe and then rupee. What do you think will influence the script of how Indian markets will move in the month of June, Europe or liquidity?
Well, I think as far as India-specific events are concerned, we are largely discounted. All the policy paralysis, lack of government action is already in the price. The only thing which can lead to either a positive or a negative move in the market is essentially global events. So I think what happens to Europe, how the Greece event plays out is going to be extremely critical. As far as rupee is concerned, we don't think there is a whole lot of downside left. In fact, if you look at the last few days, we have already seen some cracks in the dollar index. For all we know, as we approach closer to the Fed event, as people start building up more and more likelihood of a QE3, we are going to see some cracks in the dollar index, which would result in some kind of bounce back rallies in all the emerging market currencies, including rupee. So as far as rupee is concerned, I don't think there's a whole lot of downside left from these levels. However, the equity markets are more tricky to call. Let the event in Greece play out. I think only then we will have a clear picture about it.
IGL, are you a buyer there or are you a seller there?
I think there is too much of a mix-up on the policy. I don't think we would want to get into that space at all.
What's your top idea for FY13 then?
I think we would like to continue to like the consumption space. I think auto definitely looks extremely cheap at this point of time, and that's one sector we'll definitely prefer. Private sector banking names, the large cap ones especially, also appear extremely attractive on the valuation basis.